Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Ice raw sugar in New York. The core of the bullish support for the market during summer going into November had been the lower time of the December 2020 to April 2021 bullish shift pitchfork, currently at 1819. I've highlighted the whole pitchfork in dark blue so you can visualize the tines more clearly. This move up from the lower tine caused a very prominent series of rises and falls, initially capped by the middle tine, currently at 2041, and supported by the significant February 2021 high at 1894. However, in mid-December last year, prices pushed up through the capping middle time by a significant margin, but could not maintain the rise despite making and reaching a target for the November to December 2022 bullish halfway hesitation. We had prices drop back down again as we entered the new year, punching down through the middle tine and all the way down to the February 2021 high once again, though this time we also had close by the help of the combination of the rising medium moving average, currently 1934, and the barely rising long moving average, currently 1897. These together, coincidentally, were just happening to be making a golden cross at the same time, at the start of January, causing prices to revert back upwards. Indeed, shooting higher through the middle tine, then over December's high, with the last week's high being the highest high since November 2016. All this caused January to become a monthly key reversal up. Additionally, last week, to try and get a feel for what was happening, I took a look at the longer term monthly charts. And there was the answer to the question I posed of where next. We had a secondary harder to reach target X in the 2140 area for the diamond bottom formed over 2019 to 2020. Last Tuesday, prices reached target X and extended the ascent up to the resistance of the neckline, currently 2186, of the August to November 2021 complex head and shoulders top, which is highlighted in bright red, and where prices peaked last Wednesday. We've since dropped off quite rapidly. We do have support below at the November 2021 high at 2069, but I would look to the current conjunction of the middle tine and the 2023 to date 50% Fibonacci line at 2038. This seems to be an interesting level to see what the market will do next. Ice Europe white sugar in London. Changeovers produce some strange events here. Since mid-September, this market has been dominated by one action, the changeover gap that happened back then. One can say a lot of things about what happened beforehand, but that changeover gap seen here on a continuous daily chart is really big. There's been a number of attempts since to try and fill it, but each time the market stretched higher, it still ran short. Such a move happened last week with a further marginal filling of the gap, but followed swiftly by a fall. In all this, prices have utilized two patterns. The first pattern is the lower and middle tines, currently at 538.5 and 569.90, respectively, of the late October to late November 2022 bullish shift pitchfork, creating notably both a pipe bottom and a pipe top in January. I've highlighted this bullish shift pitchfork in dark blue on my daily chart to aid in the conversation. Meanwhile, the unlikely second pattern has capped the rises recently, apart from the middle tine of course, has been the neckline, currently at 581 even, of the August to December 2021 complex head and shoulders top, which I've conveniently highlighted in bright red. This was the peak last week, and prices have since come back down through the middle tine, and also the 50% Fibonacci line for 2023 so far at 555.30, until they halted last Friday and today at the congestion and let's say Fibonacci line at 548.60. This is above a zone of moving averages currently between 548.40 down to 544.5, though I suspect the lower tine in dark blue and even the late October last year uptrend, currently at 532 even, may well have potential below. However, so far, the bullish shift pitchfork is the one to watch, as its integrity still looks good. Sugar white premium spread. We are well into the new year, and this chart continues to be very, very colourful. Many things are going on all at the same time. So I've previously spoken about two big picture items seen here on this weekly chart. We have the recurring big old Andrews pitchfork from 2019 to 2021, highlighted in dark blue on my daily chart, with the market at the moment trying to repair a breach of the lower time below, currently at 88 and a quarter. That was made last week. I've said so many times before that though this pitchfork has been breached in the past, it still continues to show the overall major bullish angle of attack. But for how long? Well, on that I am not so sure. Next we have an ascending expanding wedge pattern highlighted in bright red trend lines above the market. This was formed between mid-April to late November last year, currently at 158 and 3/4, so right off the top of my weekly chart. To me, it was and still is not the best looking of such wedge patterns, but it is also still there, and it comes with all the possibilities such a pattern can invoke. The most recent activity has been the small reactionary move back up, started at the end of November last year, which peaked 4 weeks ago, and heading down last week to new lows, not seen since January last year. Interestingly, below the lower time, we have the neckline of the February to September 2020 head and shoulder top, currently at 75 and 3/4, highlighted in purple. I suspected some 8 weeks ago this neckline might end up being important, hence the highlighting, and especially when it was in close proximity to the lower time. However, these two have now gone their separate ways, and their individual supports are less than when they were combined. This led to my idea that perhaps, just perhaps, the action since late November last year may be a possible bear flag. Up to and including this week, this idea is still very much on the cards. Last week I expanded this thought and indicated potential target X below for such a bear flag stroke bearish halfway hesitation type pattern, and in the 72.5 zone, and that's just below the purple neckline. Finally, in case you are interested, the secondary harder to reach target X1 for the previously mentioned expanding wedge pattern is very hard to reach, and is way down in the 46 and 3/4 zone.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.